Hi guys, welcome to Investing with JYK, and today we'll talk about Quantopian. So Quantopian is just a website, and if you get on Quantopian, it looks like this. Some very interesting, in terms of UI, there's some random stuff here. The interesting thing is you can write your own algorithms and run backtests with these algorithms, and you can even run paper trading. So it would be it would do a simulator. So I ran a simulator for about a year now. Started last year around May-ish, and this is how it performed. So what exactly, I mean, it has performed a little better than SPY, but we have to consider, like, what is this thing buying, right? So here is the code. I'll walk through this a little bit, see if I can make it bigger. Yeah, I'll walk through this a little, just to introduce you to what I actually put in here. So here is how often we rebalance. Every week, at the beginning of the week, it will run this run a rebalance function, which is here, and there's this pipeline thing. I'm still not entirely sure about the whole pipeline stuff. I think it just runs like every time before. You can make it output something. So basically, before trading starts, you can ask it to output content. Right. So the way you create this pipeline is you. Okay, so just to make sure you're following, every single week start, I will run at the market open. I will run rebalance, but in order to run rebalance, we need to run this pipeline thing, and this pipeline is run here before trading starts. So before trading starts, this gets run, and the output of the pipeline goes into this context.output variable, and then because of this function, we run the rebalance. And within the rebalance, it actually uses like create weights and whatnot. But that's essentially what it does. So let's look at what the pipeline is trying to filter. So it's trying to generate some output. In my case, I just try to let it create a list of companies that I consider to be good. So this is a very naive implementation, right? So first of all, I say, okay, I define these variables. Market cap is market cap from Morningstar. ROIC, return on invested capital, is again from this Morningstar dataset, which Quantopian provides, and the latest ROIC for whatever company, and then the revenue growth again is the year-over-year revenue growth. Shares are outstanding. This is very obvious. EV to EBITDA is essentially a way of calculating cheapness, but trying to strip out both depreciation and taxation and interest rates, so capital structure effects. Obviously, you could use PE here too, but people argue that EV to EBITDA or even EV to EBIT, so without removing the effect of depreciation, is a better measure. So in here, I'm just going to use EV to EBITDA because that's the only thing that Morningstar gives me. I don't think it gives EV to EBIT. Okay, so what we do here is we're saying if the market cap is greater than 100 million, whatever is this, 100 million, and ROIC is greater than 10%, and revenue growth is more than 0, so the revenue is growing, and shares outstanding is not null. So basically, you can buy shares. So so in here, I am basically the most important two is these two. Market cap is to ensure there's some liquidity. For these two, what I'm saying is I want it to be a high quality company, and I measure high quality by ROIC. So excessive ROIC can be interpreted as having a moat, but obviously in this case I don't know if it's a lasting moat. You could do fancier stuff by checking whether the ROIC is sustainably higher than 10%, but I didn't do that. I'm just saying, like, sometimes these moats are not necessarily moats. Sometimes you have a temporal advantage, right? So, and I'm getting that here too, so I include that. And then revenue growth is basically its growth, right? So is a company dying or growing? So I want something that has some quality, right? So ROIC is going to be 10% or more, and then it's growing. A growing quality company, that's what I'm trying to say. But you will later see that it's not what it actually captures all the time. And then that's the math. So basically, that's the filtering stage. Everything has to meet these criteria. And then at the end, I say, okay, the screen is the bottom 20 of EV to EBITDA. So that's cheapness. I want the cheapest 20 stocks that satisfy these criteria. Okay, so basically that gets output to context.output, and then during rebalance, first of all, I say, okay, if I already have some stock in the context.portfolio, that's just the way it's really just convention. Context.portfolio has whatever I have now, and positions is just positions. So if some stock is not in my filter, does not match my filter, I order that to 0%, order targeted to a particular percentage. So I'm saying, okay, I want to sell everything. And then I try to create weights for everything in the filter that passed the filter, right? So this context.output comes from the pipeline. So that then goes into here. It is quite simply is like if I can trade it, and then if I can trade it, I would include it. If I cannot trade it, I will forget about it. And essentially the output is going to be among the companies that can be traded on that day, I want them equally weighted. And then outside here, so okay, if I cannot trade it, I'm just going to ignore that. If I can trade it, I'm going to order again a target percentage to that weight, which is generated here. So that's equal weight. So overall, this is a very simple strategy. I want something that has quality and growth, and I want the cheapest 20 out of those, and I rebalance them equal weight every week in this case. Yeah. So that's the result. It's only been a year, so it can't really tell you much, right? You can see there's some pretty big underperformance, and then they always assume that you work with $10 million, which is kind of dumb because if you look at here, I can't actually spend my cash. You can see the exposure. Long was 0, and then kind of long kind of goes to 7 million. So the biggest it ever got is 9 million, and I mean later there's more money, right? Because there's some gain. So cash, there's always like $3 million in cash or something like that. You can see cash is like, here's $2 million. Here's another, again, $3 million. And lowest it got is 800K. At the moment on this paper trading account, there's $4.6 million in cash, which is not really ideal because I really want to have like a full portfolio, 100% invested, and just rebalance those. But that's as far as I can get with this, because they force you to use $10 million, and then because my filter is for I filter by a company that's greater than 100 million market cap, which is quite small. Right? These things are a lot less liquid than you think, and so on average, the positions in here is going to be 500K, because it's 10 million divided by 20. I think it's 20. Yeah, 20. Right. So you look at 500K, and that's quite a bit of buying if you try to establish a position. So let's look at the position that this thing's currently holding. So I actually walked through some of them, and by pure chance, my actual portfolio actually contains one, I think. Let me just check. Yeah, it contains one. It contains BBL. I actually have BBL. That's quite funny. But yeah, so what we have here is, I think EGY is some kind of coal company. FNJN looks very interesting. I'm actually going to dig into that. It's some kind of patent company that deal with net security. Here's another coal. This is BHP Billiton. So the cheaper ticker, the two tickers for BHP Billiton is BHP and then BBL. They're exactly the same. BBL is cheaper. That tells you how efficient our market is. So this stuff, I mean, you could even do a pair trade. They give exact same amount of dividend. They're exact same voting rights, and somehow they're different in price. I hold that. So this is a diversified mining company. Forgot about the rest. This is Micron. So funny thing, I'm actually short Micron. So yeah. And then this thing is a long Micron. I don't have anything else. I didn't check all of those, but some of them seem to be coal related, which kind of makes sense because coal has been really bad for a while. And this is just the position they held now. it'll be interesting to see what the historical ones have. Maybe we can see it here. Let's see what this thing was holding back then. It was buying, I don't recognize any of those. EGY, it actually bought EGY long ago, 2017. And you can see most of them were canceled because this is trying to fill a portfolio of $10 million. Each position is $500,000, and then this thing just, there's not enough liquidity. I think this Quantopian assumes that 4% of the transaction volume can be you can actually participate in the 4% and not make a change in the market price. So that's what they use. So you actually get quite limited. Yeah. So what is this thing buying? IDXG, I think I might have thought about this one. Anyways, it's quite interesting to see that this thing's been buying EGY forever, and that's the one with the largest amount of gain that's currently left. Don't know about others. Yeah, and if you look at stats, right? So you could say, oh, maybe this thing is, you know, messed up in the sense that it just picks all the high beta ones. Beta has never gone higher than 1 for the portfolio, and Sharp has been higher than 1 ever since like December, and Alpha's been going up and down, and now it's somewhat stable. Not entirely sure what the hell is going on, but this is when much of the portfolio is in cash. So it's kind of uninteresting. So I also ran some backtests from a long time ago. So I don't know what the hell happened. I think that's a glitch. There's no way. What the hell is, what happened here? What? Anyway, so I ran some backtest. You can see both of them seem to outperform the market quite dramatically from 2002, and they just have very similar very similar criteria. Essentially, I changed the market cap to be more than 30 million, and the difference between those two is one is rebalances weekly and one rebalances monthly. But I think this is a glitch. But even without this, you can see the you know, even by here, this is at what, 33,000%, and then this thing is at like, you know, 2,000%. So I don't know. Maybe there's something with the timing, but it becomes quite a moot point because these are all crazy returns. So does that work? I'm inclined to say yes, and I'm trying to put my own money, part of it at least, in this kind of brainless, like completely brain dead selection of securities. You're basically playing a statistical game, and if you play it for, you know, long periods, maybe there's outperformance, and then what can be clearly observed is that in here, the portfolio is fully occupied. You could, I think you can see, no, you can see here, leverage. Oh, that's why. That glitch here is because of a bit of a leverage, because it couldn't sell, but it bought, so it went over. But if you did the monthly, then you can see the leverage never exceeded 1. Well, exceeded 1 a little bit. There's always a problem when you cannot sell. So maybe I have to, change the program so that it doesn't go crazy when, it never exceeds 1. So never take leverage. But even if you did take leverage, this is a tiny bit of leverage. So, but yeah, you can see this is mostly filled compared to this guy where it's mostly unfilled. If you look at this, it's mostly unfilled. It's like average, I would say maybe 70% in stocks and 30% in cash. Whereas this is on average like 90% in stocks and 10% in cash. So that tells me that some strategies, even though that at least I think is really good, just simply cannot be cannot be done for big players. 10 million is very little money. If you cannot do this with 10 million, these are run with 100K. If you cannot do it with 10 million, any hedge fund has to have hundreds, if not at least tens, if not hundreds of $1 million. So they cannot run this. And that's one thing that I think Peter Lynch talked about in terms of the advantage of being a small investor. This is one of them. I think there were quite a few that I might talk about in the future. I think it's quite interesting, and that is why I think as a non-professional you have a higher chance of beating, if you manage your own money. And that's one thing. It's very important. You manage your own money, you manage very little, and then you can make a lot of money. You can outperform the market quite a bit. Okay, yeah, that's all for today. I'm just sharing some experience with Quantopian, and let me know if you want me to dig further into this. In fact, I'm building a tool myself in order to execute these trades. I want to actually implement it and have a automated strategy that's running, that's independent of what I'm doing, by hand. So that might be interesting. Yeah, that's it. And if you like it, click like, subscribe, all the usual stuff. If you don't, dislike, and see you next time.